John Normand, as you put together your acclaimed research note for the weekend and for Monday reading, what were the levels of correlation you saw in markets? Are markets in sync in this tumult with the VIX out to 18, or are there interesting anomalies to the correlations?
Well, the most interesting correlation breakdown is the one between stock and bond prices. We usually think of these two prices as moving inversely, and that means in balanced portfolios, if stocks are falling, then bond returns offset that. But what was interesting last week is the reversal of that correlation to something positive. And so this means that bond prices are going down and stock prices are going down. This is very early days. If this correlation breakdown were to persist for a couple of months, as we've seen in the past when inflation surprises to the upside 2 or 3 months in a row, then you could see a much more high volatility sell-off in both of these markets. But I think the required condition for that is more inflation surprises, and it's a bit early in the cycle for those surprises to be coming so quickly.
This is the 10-year yield, John. So this is a U.S. 10-year. You can see the kind of 2.63, and it's a little bit arbitrary, but it's one of the lines that we saw as kind of starting to hit equities. Where do you see it going?
So I think if the CPI report that comes out next week gives you another upside surprise, you could easily see 10 basis points more on Treasuries. I think that the limit on Treasuries is that almost 3 hikes are fully priced already for the Fed. So you need an important new signal from the Fed to get the 3-year yield to, or the 3% level to break. And that's why this next FOMC meeting in March is going to be so important. If the FOMC does respond to stronger growth, firming inflation by adding a 4th dot to the plot or by raising its target for the terminal rate, then 3% could easily be broken.